Hello there, another Tuesday evening. Welcome, welcome, welcome. And put the pre-show on just for a second. Hope everybody's well. I don't know about you, but it seems to me that Tuesdays come around every 3 days at the moment. It's ridiculous. It's just so quick. But hope everybody is well and not being washed out or similarly affected by the crazy, crazy weather that's around the place. I was talking to somebody over in the US who's on the West Coast, and they've got this huge, huge amount. I think that they had 6 months rain in 24 hours or something stupid. So there we go. Anyway, let's just visit the dogs. Well, one dog. Meteor's somewhere around the place. I'm not sure. No, she's just moved over there. But anyway, Luna's there. Took them out for their walk earlier on, so they're pretty happy. And of course, we have the studio. Damien's teed up, ready to come in. He's just making some last-minute tweaks to his slides, and of course, we've got all the normal stuff, the chat running and everything else, and the multi-view and things like that. So we're all set up, teed up, ready to go. And should be a very interesting conversation tonight, given the various dynamics that we're seeing at the moment. Should be fun. And as normal, we'll be willing and able to take your questions as we go through. So look forward to that too. Anyway, I'm going to take the pre-show off. I'm going to start the show. Well, good evening and welcome to this live stream on the 6th of February 2024. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. And it's our monthly exploration of the markets and everything like that with Damien, who's teed up ready to come in just a second. Lots to talk about, of course. The RBA today held rates as expected. They ran their first press conference. We'll explore that briefly. We'll talk a little bit about the Magnificent Seven, or is it Magnificent Six? We might touch on China as well and what's going on there and what the implications might be for the Australian economy. And of course, the broader question, what does all this mean in terms of investing? You know, the forward expectations of earnings look to me to be weakening in some areas and quite strong elsewhere. So what does that all mean? So hopefully we'll be able to explore some of that today. Before I bring Damien in, let me just remind you, as I always do, that we're not providing specific finance or legal advice, general conversation only. Do please play nice in the chat room, but feel free to questions, comments in the chat, throw them in there. And, I don't necessarily look at everything that's going on in the chat, so feel free to have other side conversations. But if you want to get your question through to us, then use that Walk the World. That'll get my attention and get it in the queue. I've also enabled Super Chat, which means you can get your question to the top of the list or indeed make a contribution to what we do around here. Really appreciate all those who make contributions. It helps to cover some of the costs. We don't do this for profit. We do this because we think there's a really important conversation to have about what's going on. And frankly, some of the mainstream media, to my mind, don't necessarily cover things that well. So we try and give a more hopefully balanced and objective view of what's going on. Anyway, with that out of the way, let me bring Damien in. And Damien, how are you going? Good to see you again.
Yeah, good to see you, Martin. Good to see you.
I don't know about you, but it doesn't feel like a month. It feels more like a week or so since we had the conversation.
No.
But there's
all
so
this
much
stuff I'd planned to do, and then it never got done. Yes,
I know, but there's so much going on. Let's just briefly talk about the RBA. Of course, the RBA held their first press conference today, and there were a few, Mickey Mouse questions from the press. I have to say I wasn't particularly impressed by the quality and preciseness of the questions, nor indeed of the answers. But, the top line is, of course, that they're going to be data dependent. They don't see inflation coming into band until, 2026, middle of band. That's the latest from the monetary policy statement. But then they said, well, it might go up, might go down, might go sideways. So they're really playing the same waiting game as other central banks. And, again, I think the markets were probably expecting more cuts more quickly. And she's always said, well, we're not forecasting, we're just giving you our modeling. Any takeouts from you? I mean, it wasn't a huge amount of surprise to me.
No, there wasn't heaps in it. I guess there's a couple of things I'd like to note with it. So one is they did downgrade their forecasts for some of the later inflation. So they are obviously, the numbers they're seeing are similar to the numbers we're seeing, that inflation's coming off pretty quickly. They did note, I guess, though, a whole sort of you'd call it more of a hawkish hold. I'm talking more about that they might raise again, which I don't think they will. But I guess that was sort of they're keeping I guess at least the rhetoric up in terms of that. And then the final one is that as a new person in the seat, I think her the risks for her in terms of making a decision are higher than the risks of not doing anything.
Yep.
So, if she puts rates up and inflation crashes faster, or you get higher unemployment or whatever it is, then she'll be held to account for that. If she puts rates down and inflation comes back, she'll be held to account for that. But if she doesn't do anything for a little while, then that's sort of that. Well, that was what the last guy was doing anyway, and so it's sort of So I think there's probably a tendency to there usually is a tendency to do nothing, but I think there's probably more of a tendency now than what there usually is.
Yeah, I think that's exactly right. And she was asked whether the November rate hike was appropriate, and she said absolutely it was, based on what was going on then. To my mind, actually, the AUD is an interesting thing to look at, because if you look at some of the things that are going on there, you'd have to say that it's sort of wandering down. And of course, a weak Aussie dollar does have consequences. So what is the relative strength of Australia vis-a-vis some of the other currencies around the place? Obviously a strong US dollar at the moment. But that's got to be part of the thinking, hasn't it?
Yeah. And so I think certainly from internally in our strategy, David, who you've had on this, David Llewellyn-Smith, who you've had on this program a few times, I think, does a lot of the currency, and so he was for a while there. He was talking about saying, look, it's headed towards 70 cents. It probably wants to touch off 70 before heading lower, and he's changed his mind and gone, no, look, a week or two ago, changed his mind and basically said, yeah, no, it's had its top. It's now it actually looks. We just did a podcast last week on it. It looks to us as if the Australian economy, which was behind most of the other economies coming out of COVID, so because we had longer lockdowns and we were sort of like, our growth rate didn't kick off until afters. Our inflation was behind everyone else's, but given the way the interest rates work in Australia, they flow much more quickly through to the Australian economy. And effects over China, we're actually and the effects of all the people that are coming in. Our contention now is it actually looks like we're catching up and quite possibly going to pass some of these economies, and we might be coming down the other side of this inflation heap faster than what some of the others have. Oh, sorry, the other growth side. In terms of inflation, there's still the two or three key things for Australia is we're running much higher immigration than any other country. Or Canada, I guess, is giving us a run, but most other countries are running just aren't running immigration anywhere near ours, and so that's putting a lot more pressure on house prices in Australia, which will hold inflation up for a bit longer. It also keeps wages lower, so it's actually the worst type of inflation. So if you're getting what they're seeing in the US, which is where wages are growing, and therefore there's this. That's spiraling into some inflation. Economists have a bit of a concern about that from is that inflation endemic and all these things like that. But from a person within that economy, you're getting wage growth and then you're getting inflation, and you're getting wage growth and you're getting inflation. And so you're sort of keeping up or in front. Whereas Australia's got the opposite problem where we've got this inflation, but we're not getting the wage growth. And then the last part is the energy side. Now, energy prices have come back a long way, but Australian politicians have shown that they're not interested in protecting Australia, in taking advantage of the low prices we have in Australia for energy. They're happy to leave us to the mercy of international markets, and so we are seeing sort of inflation there that's a little bit higher than what it should be.
Yeah, I mean, one of the themes came out clearly in that press conference was that a lot of the inflation is homegrown now. A lot of it's services related, things like rents, etc.
I don't even call it self-inflicted.
Well, I think that's exactly right, because that was going to be my next conversation. It is self-inflicted. And the other point, of course, is that the actual headline inflation rate is being helped by quite a lot of government handouts, specifically for those in the rental sector and for some of the energy. So if you took those away, then the actual true inflation would be quite a bit higher. So the numbers are not necessarily what the numbers. She said, well, we're at 4 point something. Somebody said, well, I thought it was 3 point something. So it depends on how you look at the numbers. But it's tricky. The other point I would make is through COVID, relatively speaking, the amount of money that was thrown at the Australian economy by a combination of the RBA and the government per capita was a lot bigger than a lot of other countries. So one of my arguments has been for some time, there was probably more carry post-COVID in Australia, but that's now running out of runway quite fast because the savings ratio is dropping. So effectively, whilst they can do a few things, the fundamental economics of Australia are now, I think, being challenged, and we'll come onto this later, but of course China is part of the problem there too. Interestingly, the Cookie Boy put this comment up a little while ago. Let me just pick it up. Hang on. There we go. The RBA released its quarterly statement on Tuesday. Yeah, inflation back in the middle of target, mid-26, was 23, was 24, was 25, now 26. And I think that's part of the problem, right? They keep kicking the end game out. So the longer they keep this sort of story afloat, the risk is, of course, that higher interest rates grind everybody further. And she was at pains to make the point that inflation's, a problem. But I would say high interest rates are a problem too.
Yeah, so I mean, this is the question: is saying, if we've got high housing costs, does high inflation, does having high interest rates fix that problem? And you go, no, it doesn't. It probably makes it worse. At the margin. At some point, and it's tough to get loans and everything, all that type of stuff. If you've got, that after effect still flowing through from these high energy prices, well, does having high interest rates go fix that problem? No, it doesn't make any difference. We've opened ourselves to the world. We're running on world energy prices, and so I do feel as if there's still a focus that I'd love to see more in terms of actually looking at what's wage growth and what's real wages doing, because real household disposable income is going backwards for per capita on a per capita basis. If we're worried about the actual effect on people, individual human beings living in our society or in Australia, then we're getting the opposite effect that you'd like to see. And so anyway, that's where we are.
We are where we are, and I guess the question is, where are we going, right? And so let's try and break this apart, because of course one of the remarkable things that we had was a massive run up in markets from late October onwards, powered very much by the Magnificent Seven or Six, depending on how you look at it, right? So I think it will be good to spend just a little bit of time exploring the Magnificent Six, Magnificent Seven, as a way of getting into the big question which I've got, which is, are future earnings expectations justifying the valuations of markets? Because that seems to me now to become the really critical question as we go forward.
Yeah, that's right. And so, so lots of different ways we can look at this. I guess one of the things to note is that, I think last time I was here, I was talking about how 2024 forecast earnings were still way too high. Now hasn't completely reversed, but it's come a long way. So we were looking at almost 10% growth for companies last time I was on this show, so a month ago. Now that rate's a little bit over 5%. So earnings have come down, significantly. We've almost halved our growth rate in terms of for 2024.
Right, and now, just to make the point on that, Damien, that's because, of course, a lot of analysts plug in a sort of a 10% number at the start of their assumptions, right? And then they start getting real data, and then they have to sort of tweak them and tune them. So this is unsurprising. But the point is, the market pricing particularly a lot of shares, are probably over what they should be based on now the current levels of expectations of earnings that we're seeing.
Yeah, that's right. And I think I spoke as well that this tendency of people to go, okay, so we're going to look at 10% growth in over 2 years, and you go, so starting with 100, then they go to 110, then they go to 121, and then they look at the first year and they go, the first year is like, oh, it's going to be a bit disappointing. It's not going to be 10, maybe it'll only be 7%. So I'm going to take 3%. I'm going to downgrade that from 110 to 107, and maybe the next year, might not be as bad. I'll do that from 121 back to 119. And so it sounds reasonable when they do it. But now what's actually happened is now you're growing from 107 to 119. You're growing by more than 10%. So you've got this, you've factored in this much higher growth rate from the first year to the second year, more because they're just they're trying to downgrade their numbers, and they're just not, they're looking at the one they can see. And then it's not until they finally report, and it doesn't come in at 107, it comes in at 105, and they're like, oh, great, I've got that. And they look at the next year and go, oh, wow, now I've got 15% growth forecast for next year. That's not going to happen. And then they start winding it back. And we're in that period now where companies are finally coming in with their 2023 numbers. And so now they're looking over as they're reporting, they're like, oh, let me have a look what I've got forecast for next year. Oh, wow, that's pretty, that isn't going to happen. And so, yeah, that's this position we've been in for the last month or so, where we've really seen those numbers come down. And I think there's further to fall within it. So, so the Magnificent Seven, they really have, in 2023, they really dominated the growth rates. So, 2023 numbers are going to come in probably around about even with the prior quarter, prior year. So about no growth. But if you took out the Magnificent Seven, you'd be down, maybe 4% in terms of growth rates. So we've managed to hold on to where we were last year, but because of that Magnificent Seven, in terms of getting that great growth rate. So
and just to say that, there's been a lot of volatility, right? A lot of swings up and down, and some market participants benefit from that volatility. But it shows you, to my mind, volatility is an indicator of uncertainty. What I find fascinating is the VIX itself is still not very extended.
No, it's very well behaved.
A lot of that volatility is not really reflected in some of the indices that you would have perhaps have expected to see it in.
Yeah, that's right. That's right. So let's I might start with I'm going to start with some of the ones that I think have got the more problems in the Magnificent Seven. So if you look at Apple as an example, so they're sort of trading on, and actually just for anyone, so a market multiple is usually, so I'm going to talk about price to earnings. I'm going to talk about forward price to earnings. So usually you'd expect companies to be trading on somewhere between 15 and 18 is typical for most companies over a longer time period. The better companies will be above that, and the worst companies will trade below that. So Apple's sort of trading on about 28 times, which is pretty expensive, and more so very expensive relative to Apple's recent history, and expensive in terms of growth rate. Like we're expecting single-digit growth from them, so it's sort of like 5% growth or 7% growth. They're having problems in China. It's just not the type of company you would expect to be trading on such high multiples relative to the growth that it's actually bringing through. So look at Apple and I go, is there a bubble in terms of prices? And I look at that and go, yeah, well, look, it's certainly expensive. Look, I love the company, got some great earnings, and the earnings are still headed up, and and they've been pretty solid over the years. But they are running into problems in China, and they do look very expensive. The other one,
just on that. Of course, they've just launched the Vision Pro, which is this very expensive, three-dimensional thing, which potentially has, maybe trajectory down the road, but is probably not going to do a huge amount immediately. It's more sort of strategic positioning. The real question is, to what extent will older iPhone users upgrade? And there are, of course, in China now some competitors that are actually trying to eat some of their lunch too. And
Yep.
some of the
And the
suppliers.
Chinese government's banning their government officials from buying Apple iPhones because of security issues. Yeah.
And they also have some supply chain issues too. But of course, a lot of what they are doing is still some of their infrastructure and some other bits and pieces. So there is still a base, but the momentum of growth is the question, isn't it?
Yeah, and there's a bunch of interesting things that maybe if they get it right, they could they've got some quite interesting things they're doing on the chip side that they could that could come in and they could be selling those chips to others. They and the design in terms of they were very early onto this idea that you're much better rather than having one big chip that's really powerful and a very generalist chip. Is actually better off having lots of little small chips that are much cheaper, but much more specialized. And so when you want to crop a photo or do something with the photo, it's a different chip than the chip that actually runs your power system the whole time. We can have a much lower power one that keeps your phone alive. And so they're very early in on some of that. They've got some interesting technology. They're trying to do some stuff on AI chip things, processing. Yeah, maybe something else, maybe something great will fall and I'll be wrong. But just based on the forecasts that are coming out, it's that part about always trying to look at companies and say, okay, I can really like what they're doing and I can like their growth prospects, but that doesn't mean I'll pay any price for them. What is the limit of the price that you want to pay for it? And so I'm certainly happy to pay above market multiple, but the question about how far above. And then that's very much the story for Tesla, which is a lot of people describe in terms of buying is more about more like a religion than doing a valuation. Is it's always been expensive, but they are running into some pretty serious problems and profitability, which for years and years and years just went up and up and up, has for the last year and a half has been falling in terms of forecasts. And so the expectation now, well, 2 or 3 years ago, well, it's not even mid 2022, people were expecting by 2024 that they'd be earning sort of $7 a share, and that's halved in terms of now that's sort of more like $3.50 a share for next year. So China is busy subsidizing EVs as fast as they can. We've got Europe talking about whether they're going to be putting tariffs on some of the Chinese EVs. I guess there's debates in the US about how much they should be subsidized or not subsidized. There's already a package through that. Will there be more subsidies for it? Probably not. There's certainly issues there in terms of just the pricing, in terms of saying it's expensive. And it's always been expensive, but the question for a while there, it was valued at sort of more than the rest of the entire car sector, every other car maker in the world combined. There's a question for these guys who are trading on 55 times next year's earnings. And I spoke about sort of the market multiples. You're probably more like 18-ish for companies sort of like your average. Most of the rest of the car sectors are trading on single-digit PEs, so you can buy them for 7 times earnings or 6 times earnings if you want to buy a traditional car maker, or you can, for almost 10 times more, you can buy Tesla. And so it's a question about going, you might like Teslas, you might think they're much, much better than say Toyota, but are they 10 times better than Toyota in terms of valuation? Or, where's the limit reached in terms of those? And so, so earnings have not been good out of Tesla for a while, which is why you're alluding to it being, maybe it's only the Magnificent Six. And you showed there the share price graph, has not been as good as the other ones. So so that's the ones that are sort of dragging a little bit. And sorry, the other one was Google. They came out with some numbers that disappointed, and the share price fell quite significantly. Google is basically trading on a market multiple, so it's trading at 20 times earnings at the moment, which is sort of pretty similar to what the US market is. You've got growth rates of 15% per annum sort of forecast for the next 2 years. Yet certainly earnings have not been as good as they weren't as good in this latest report as what others were expecting, as what analysts were expecting. But to buy a company on a market multiple at that's doing 15% per annum growth is, not a bad deal generally. The questions there are some questions about ad cycles and if you go into downturns and all that type of stuff. But I guess if you're looking for a bubble, you can sort of see it in Tesla, you can see it in Apple. You get to Google and it doesn't look as expensive. I guess there is an argument that says that media companies and mature media companies should trade significantly cheaper. So traditionally, you see, things like your News Corps and your papers. I guess if we were around 20 years to sort of when they were the kings of the media sector, they would trade on usually a below market multiple. But it doesn't take much to argue that Google's still got some still got a pretty reasonable growth sort of factored in. So yes. So and then the ones that sort of excited the market were some of the others. So I might talk about Meta. Now that's one of our bigger holdings. So Meta is Facebook, and it's been interesting in that I think its jump following its result was the largest ever one-day increase in terms of market cap for a company, I think. So it's now it's trading on 23 times earnings. So it's sort of a little bit above, so 10 or 15% above what we saw for Google. The only thing, I guess, I look at Meta in a different way, which is why it's been one of our largest holdings. And the reason why I look at it differently is it's still spending an incredible amount of money on the metaverse, which is basically 3D technologies to help 3D technology. So I guess their vision for the world is that we went from using dumb phones and texting each other to gradually getting smartphones and then putting social media on and moving more into videos, from texting to interactive websites to videos, and then the next step is going to be 3D, and they're trying to get ahead of that. Now they might be right, they might not be wrong. Who knows? They are spending an incredible amount of money and making no revenue from it. So if you said tomorrow that they shut down that whole division, they just said, no, you know what, we were wrong, shut the whole thing down and just go on with the rest of their business, that PE would fall from 23 times to 14 times or 13 times. It would make it one of the cheaper stocks in the market. And that's the reason why we've sort of been buying it and holding it in large amounts, because it really comes down to what your view on that metaverse is. Is this thing that's just going to be dragging on their earnings forever? In which case, maybe it looks a little bit expensive. If your view is that this thing is, worth zero, and I'll separate that out, and it's worth some sort of negative cost that eventually they'll make back, roughly what they spent, but it's not actually worth anything, then this stock looks cheap at current ones. And if you've got a view that the metaverse is going to be fantastic and these guys have got it right and they're in on the ground floor and they're going to be the kings of the metaverse, then this stock looks dirt cheap on that basis, because you're basically saying, well, that you can take out the money they're spending on that and treat that as just sort of separated into the two companies. So that was one of the more exciting ones, and I think there's going to be ups and downs, and it's just rocketed, for it was up 20% in a day, and so there's had some pretty incredible performance, but as a longer term play, I'm not that upset still to be a holder of that.
And just to make the point, they did actually pay their first dividend, and they also announced a significant share buyback.
Yeah, that's right. They're spinning off lots of cash. They've got that's and some people do have objections to social media in terms of saying that what it's doing to people's brains and the world and all that type of stuff like that. And I have some sympathy. I don't think it's helpful for people, but they're certainly making money from it, and there's been plenty of technologies over the years that everyone said is ruining your brain and wrecking society and everything from moving to television from radio and probably from radio from nothing and all the way up the chain onto computers. So we did those ones. Microsoft. Now Microsoft is interesting I've sort of put this one in the middle of look, it certainly looks like it's in a bubble. It's trading 32 times next year's earnings. So it's getting pretty good growth out of that. You're probably going to get 10% growth, 10 to 15% growth out of it for the next few years. It's up to its eyeballs in AI. So not only does it have significant exposure from the in terms of into ChatGPT and the associated factors, it's also got lots of cloud computing. It's got pretty much an unassailable position in a whole bunch of different software products that people are just going to buy because. And that's one other factor. And there's a potential that maybe they'll actually start making some reasonable inroads into search. They've got a lot of their AI driven stuff. Might I don't know what you call it likely, but it's certainly more likely than it was 2 or 3 years ago that they can make some more headway in terms of search. So and just a metronome in terms of their earnings just keep rising year after year after year. So extremely high quality company. Now it's just a question about how much you want to pay for that. It is looking, starting to look expensive. Well, not starting to look, it's looking expensive. But you're getting very high quality. And so, I guess I have mixed feelings about it in terms of where, we're certainly getting close to the point where I'm not adding any more to it, to our positions, and considering whether I need to lighten up on some of the holdings, I guess is where I'm sort of sitting on that.
And it's worth just making the point, of course, as well as the software, they've got their whole cloud computing, Azure, and those sorts of things, right? Which is actually quite a big contributor of sustained income growth.
Yes.
And interestingly, if you link that back to AI, it is the infrastructure that ultimately is the growth engine at the moment. The other stuff may come later with terms of, changing business models and things, but a lot of it's infrastructure at the moment.
Yeah. And I think Microsoft's main problem is that they're so big that even that, which is, a major part of their company, is just doesn't move the needle enough, I suppose, in terms of, they probably, you can rack out 20, 30% growth, earnings growth in terms of those sectors, but then it gets sort of, because it's such a huge company, that sort of gets, spread out sort of over 3 trillion in market cap. So, you really need to grow, really, get some quite significant growth to make that show up. Now, did want to talk NVIDIA. Have I missed anyone? I did Tesla, didn't I?
Talk Amazon.
Amazon. Oh, sorry, that's yes. That was who I wanted to talk next. Yes.
Do you want to Amazon first or NVIDIA first?
Amazon first. Amazon first. Now, Amazon is very much a company as well where you need to look at it 3 ways. It's got 3 different divisions within it. It's got it's got Amazon.com, the retail website, and I split that into 2, either the international and the American side. Now, the international side doesn't make any money. It's never made any money. It's maybe they'll get it right, but they've been at it for a long time, and it basically breaks even. Doesn't really lose much, but never really makes much either. So maybe there's a bit of an option there, but if that was trading on its own, it wouldn't be worth that much. The US part of the Amazon is this really interesting part where it makes a massive amount of sales and it makes tiny razor thin margins. And because the margins are so small, if it moves from a 0.3 margin one quarter to a 0.6 margin another quarter, they've only changed by 0.3%. Well, they've just doubled their profit from that division. And so they go through these bits where, and people, there's a common argument going, well, at some stage they'll stop going for growth and they can normalize their margins and put them back up closer to what other retailers make, and these things can be worth a mozza. Maybe they've been around for a long time with a growth model. Maybe there's questions about whether they can do it or not. If they put prices up too far. They're certainly going through a phase at the moment where their margins are expanding and they're actually starting to make some reasonable margins in that division. And that's part of why we saw this big pop. Now, the question is, how sustainable is that? Anyway, I guess there's this, you sort of go, got the international division I probably don't want to pay much for. I've got the American one, which is a dominant online retailer. It's absolutely worth something. It's actually worth a lot of money. Just the question is saying, is it worth a lot more than because it's got this latent earnings that it's not taking advantage of, or is it just worth a little bit more because actually, you know what, it'll just never be able to make the same margins that other ones make. And then you have this rocket ship, which is AWS, so the Amazon Web Services, and that's cloud computing, and it's they're the leader. They just grows year after year after year. Yeah, they had a few disappointing quarters where they only grew at 15% rather than 25% like they'd seen, and sort of and so you sort of strap these three things together, and you're like, right, how much do you want to pay for this? Now, the AWS part, you want to pay a lot for that. That's growing. It's got, it makes fantastic margins. So we're talking about, margins in their retail bit, sub 1% in terms of what you're pulling out in terms of profits. In terms of profitability in the AWS, you're talking over 50%. So, it's just chalk and cheese in terms of what you're getting from it. So how much do you want to pay for it? And so you're paying, even on sort of quite improved numbers, or not quite improved numbers, dramatically improved numbers, you're paying 40, 50 times for, or maybe 40 times for their earnings. So, 2026 numbers forecast for 2026 went from, before the end of the year, they were trading at sort of, people were expecting them to make $4.50 a share. Now they're expecting them to make $7 a share. So you haven't quite doubled your profits, but you're up 70% or something like that in terms of the increase in what people are expecting, and it's still trading on 40 times. You still double the market multiple, and so they've spoken a little bit about spinning out the AWS, and that would be very interesting at trying to work out then. If you look at other online businesses and what they trade at, and then versus AWS. So I can sort of do some numbers that if I look sideways and sort of glance upwards, the glass sort of looks half full, but it's always expensive. And then it's just a question about what's the right multiple to pay for three very different businesses with very different growth profiles and very different margins within it. So, yes.
And just a quick comment on that. Of course, they did start putting adverts in their Prime subscriptions.
Yes, that's right. So, well, that's right. You've got Prime, which is an afterthought in a way, relative, and it's that whole part about the Amazon. Their sales is so massive that you can start up a whole division like that, and it barely makes a dent in the profitability because they're just so huge in terms of their sales.
Yeah.
And then the last one, Nvidia. So, it's all about how much growth you see within the AI sector and how much you think they'll be able to take. Now, they are growing at an incredible rate, and I think they are going to keep going and growing at an incredible rate. And they don't look, given their growth profile, so they're going to be they're looking at so if you drew back, say if you looked at the average they earned from 2017 to 2021, for example, you'd say they earn about $1.50 a share, say. They're looking like earning $20 plus a share over the next couple of years. So it has been an incredible increase in terms of profitability. The sales are sort of doubling. So that's the good side. Now, the bad side of it is They are in an industry which is a very nasty industry, as I was talking to you before, Martin. It's there's not a lot of brand loyalty from the big guys. I'm talking because they're selling to data centers. So if you've got the best chip, the data centers will buy from you, and yeah, they'll probably keep something. Even if you haven't got the best chips, they'll keep something because they like to keep a few companies alive and spending money on R&D and all that type of stuff. They don't want to end up in monopoly situations, but you've got to keep coming up with the greatest hits. Now, NVIDIA looks like they've got a pretty reasonable gap between them and everyone else, but Google's working on chips, Apple's working on chips, Amazon's working on chips, AMD's working on chips, Intel's working on chips. Half of China's working on chips. You've got people out there spending a lot of money to try and catch you. So that's one part of it. The second part of it is last year, on all data centers, there was about 200 billion spent. Now we know that's going to increase a lot, but the forecasts basically have for AMD, sorry, not for AMD, for NVIDIA over the next 2 or 3 years, in the next 2 years, making over $100 billion in sales. So they're basically doing, so if you think about a data center, you got to buy you got to get all the electricity, you got to have the people working in it, you got to get all the clean rooms, and you got to get all the power, you've got to get computers, you've got to get memory for those computers, you've got to get hard disks for those computers. Like there's all these things you need to get. And we're looking at basically saying these guys are going to make $100 billion or over $100 billion out of something that last year was in total was spending $200 billion. So is it possible? Yeah, it's possible. They're going to have to keep 90+% market share of what they're doing. Plus, you're going to have to get this incredible growth, and I do think a lot of that incredible growth will probably come through, and no competitors will have to come up. And the problem I spoke about that being this nasty industry is that when you look at Intel and all these other chip makers, AMD and these others that have been the leaders at certain times in the latest and greatest chips, traditionally, people won't pay up for it. You don't pay these massive multiples for it. You pay sort of 10 to 15 times earnings for it because you got to keep producing that chip every single year. It's much harder and much easier for people to switch from they stop buying your chip and start buying somebody else's because the other one's better or cheaper. And so so they're in this sweet spot now where everyone wants AI, everyone wants to put it on as fast as they can, but it's there. They've got a lot they could possibly lose, and they don't even have to lose that much for those multiples to come back, and people stop paying 35 times earnings for them and start paying 15 times that they usually would. And the other thing to note as well is they don't do any of the manufacturing. So all the manufacturing is done by TSMC, which is or not all of it, but most of it's done by TSMC or others like that, Global Foundries. And so if somebody else does come up with a better chip or even just a similar chip, but that's much cheaper, they can get those produced. Like NVIDIA managed to scale up its production so quickly, not because if it had its own factories, we would have been talking about a 5-year cycle where they built the factories and then tried to get them up. They just basically went to TSMC and says, "Hey, can you turn on all these extra lines?" And TSMC went, "Well, if it's going to be double the profitability of our other customers, absolutely, we'll turn them all on." And they can very easily do that for a competitor product or something that's a chip that's better or cheaper or whatever it is, some sort of combination of the two. So yes, so looks good. If everything goes right, then they're probably you could make an argument that might be all right buying them here if they get everything exactly right and it all lines up. But it's got to be perfect. You got to thread that needle, and so I'm not going to stand in the way of that one. I certainly wouldn't be shorting it, but it does look pretty expensive for what it's actually doing. And at some point, it'll come back to earth in terms of at some point that growth will slow and you'll see it trade on more like 10 to 15 times, like all those chip guys do.
And I suppose that, Cookie Boy asked the question, is NVIDIA overpriced, which is part of the question. But I guess the other part of my question is, to what extent is this a mirror image of the dot-com bubble in the 2000s? Are we seeing a similar significant run-up and overhype? Are they going to come back? Or is there enough reality here that this time it's different? What do you think?
Yeah, well, my favorite comparison is Cisco. So Cisco produces routers, which basically divert. When you send out messages on your computer, it basically takes it and diverts it wherever it needs to go. And they're really high quality. They're very much was always seen as one of the best companies out there. If you look at their earnings profile from the dot-com boom, it looks great. It's just this 45-degree line. It just goes up and up and up and up every single year. You just get more and more earnings out of them. From a fundamental perspective, they've done everything that you tick every box. But if you bought them in the tech boom, you would still be down on them today in terms of profits. So it's this question about how much do you want to pay for that? So from a fundamental perspective, their earnings increased. I think they're probably up 10 times, maybe at least 5 times in terms of earnings. But share price has fallen because it just got so expensive. Now, NVIDIA's not there, not quite at that same massive price, but it's playing the same ball game. Yeah. So it does look expensive. You do need to use some really aggressive forecasts, and you need to assume that they're just going to make they're going to stay at 90% plus market share. And could happen, but seems seems unlikely.
And just on that, here is the long-term Cisco story, right? So you can see there that the price hit a peak of about 80 back in the year 2000, and we're now at 49. So I guess the question is it legitimate to say that we are somewhere in the slopes here, right?
We're on the way up. Yeah,
So,
that's right. You could justify. I can certainly see where we could justify the current price, in 5 years' time. But I can see lots of scenarios where they might fall back to 50% market share or 60%. They might be the dominant player in the market, but they're just not. They're no longer. They're no longer getting 90% market share. And they revert back to a more normal market multiple, and the share price is down 30-40% from where it is today.
Yeah.
And so that's,
And so just go on.
I was just going to say, you'd look at objectively, if you looked at them and went, they will be making if they're in that position in 3 years' time, they're going to be making way more money than they are today. Keeping 60% market share in one of the biggest markets is a great success. They're still a good company. They're still doing everything right. It's just a question about how much you want to pay for that.
Yeah, absolutely. And, just going back to where we came into this conversation, the broader index is up, but about 30% of the index is now represented in these 6 or 7 shares, right? So,
yes.
so if those stocks are going so strongly, what does that say about the broader market?
Yeah, well, it says what when you look at the equally weighted indexes, you get a much more sanguine picture about whether markets are rising or not. And we spoke about the earnings elsewhere. So earnings for if you're not part of that, you pretty much halved your earnings halved your earnings growth rate. Sorry. And so then the question is this, is it going to get better over 2024 or is it going to get worse? And so I still find listening in on company announcements, there seems still, and there's certainly a lot more, we're seeing a lot more earnings downgrades, but there still seems to be that factor of people still saying they think they're going to keep getting their sales growth, but they think their costs are all going to go away. That's the large, if you're looking for a positive story, is that companies are basically saying, yeah, look, our costs are all falling or flat. With that inflationary burst we don't have to worry about, and so we'll put through our sales growth, but our costs won't be anything, and we'll make this. This is what our profit growth is going to be. And it sounds all right until you actually take a big step back and go, well, yeah, but my costs are somebody else's revenues. And so if everyone's saying the same thing, that their costs are falling or flat, but they're going to put their sales up, then everyone can't be right. So yeah, it's a question about which are the people that are wrong in that.
And just on the equal weight, this is just the equal weight ETF for the US. And what you can actually see there is that it actually was higher in 2022 than it is now. So that's an interesting object lesson, isn't it?
Yeah, absolutely. And this is a question. And so I've spoken before about saying quality stocks is where I think if you're investing, look for quality stocks. And what do I mean by that? Is I mean that when you get inflation, it gives companies a chance to put prices up. And now some companies don't get chances to put prices up very often at all. So say car companies or tire manufacturers or sort of more commodity type goods where you've got lots of competition, they go through these whole cycles where they just can't put their prices up, or they have to cut their prices every year. And then suddenly we get this burst of inflation and they can all put prices up and it's fantastic for them. And they're your value stocks and not your high quality stocks because they don't have big margins. They don't have these wide moats. And so things are great while inflation's going up. When inflation's falling, though, they're the ones that have to put their prices down. And they're the ones where you get price wars break out. And they all start trying to, they've all just built new factories because they're making these great margins, and so then they want to fill up their factories, and so they're all trying to get more volume through, and they're forcing prices down, and there's so many competitors that there's not the same discipline. So what I'm trying to say is try and avoid those companies, the ones that did really well as inflation was rising, and not the same companies that are going to do well in the falling inflation environments. You want the companies that are largely sort of monopolies or oligopolies, and they've put through price rises, but they're probably going to be able to hold on to them and maybe even put prices higher. So, I look at a company like a Microsoft. They put through price rises for things like their Office products. Maybe that'll fall away if businesses, start dropping back, but chances are Microsoft's not cutting their prices. They're not looking at it going, if we just cut our prices by 5%, we'll sell all these extra copies. They're looking at it going, it's a sunk cost. Company's going to pay for it if they've got somebody sitting there. And so, it's you want companies that are going to be able to hold on to those price rises. So the higher quality companies, bigger margins, bigger moats, as Warren Buffett would say.
So I guess the question then is, if you look at let's say the S&P 500 in the US, just as an example, right? So we're touching all-time highs at the moment. But you'd have to argue a lot of that is driven by those 6 or 7 stocks. The broader economy may be a little less strong than perhaps people were expecting. The interest rates will probably be higher for longer. So are we really in a point in the cycle where markets are now overvalued?
They certainly look expensive. Yeah, they look. They're sort of at the. You'd say they're close to the 80th percentile, I think, in terms of pricing. So they're not extreme, but they're for the growth rate that we're looking at, they're right up there. So the times where we've been higher than where we are today, in the last, say, 30 odd years was during the tech boom and as we came out of COVID. So two times you've had markets that were more expensively priced than today. Now, the benefit of those 2 times was there was growth, or at least whether there was at least an expectation of growth. It's certainly in the tech boom, there was growth at the start, and then as things were taking off, there was this expectation that I'm paying up multiples, 30 times for earnings or something like that, but on average, the markets are growing so quickly that that can justify that 30 times. Coming out of COVID was a similar story. You're paying up sort of 22, 24 times earnings. You could justify it by, actually, we've just come out of COVID, we're growth boom, all this earnings, pricing power. You can justify that from a. So if you start on 24 times earnings and you grow at 20%, well, now I'm below 20%. Now I'm below 20 times earnings. So you're sort of more back to normal. So the question now is, are we willing to pay top dollar for a market that's looking like it's going to grow at, well, at the moment, the growth forecast in the last month and a half has just gone from 10% to 5%. And I would expect it to end up probably pretty close to zero for 2024. The half full version is that, look, there's actually a lot coming down the pipeline over the next few years. So if you look forward past this year and out to the following year or the year after, then you can see some growth rates and all that sort of stuff. But you're going to have to get some pretty good growth. Ideally, look, I'd love to get a chance to buy at a cheaper rate. I'd love to see a pullback and as earnings fall. But I guess if we look at the last 6 weeks, we saw the growth rate almost halve, and not a lot of movement on the prices. So we might need things to be a fair bit worse, I guess, in order to get the market to pull back.
Yeah, and I guess the point is, being in the market is being in the market, right? So you've got to try and make the best of whatever's going on, right? Which is an important point. Now, just let me put this one up because Phoenix, thank you very much, Super Chat. You asked for the Pfizer chart, which I'm happy to show you. And you can see there that it hit a peak in 2022 and it's come back down. In fact, a number of the stocks in the same sector are actually now significantly down from where they were. And it shows you that actually, it's interesting. Again, when you start decomposing the market and looking at, individual sectors and individual stocks, the sectors are actually all over the board.
Yeah. Now, and that's, I think I don't know if I spoke to you last time, maybe the time before, about healthcare, and our take on healthcare is that these obesity drugs that are out could really be game changers for that sector. In terms of, there is a lot of diseases where if you're 10 kilos lighter, a lot of the problems go away. Whether you're talking about hip replacements, sleep apnea, high blood pressure, you just diabetes, you just go through all these different factors where, if there's a reliable way of getting people to lose weight, that actually gets rid of a lot of the medical problems. And so, so we've got a lot of those obesity drugs that we hold. And then on the flip side, though, we've actually been trying to be underweight most of the rest of the sector with a view that, look, if overall health costs are going down, then because you're just having fewer extreme cases, if that's your sort of outlook for the next, 5 years, then it's probably not that good for the healthcare sector.
Absolutely. And
that might be a reasonable jumping point off into some of the thoughts on, because they sort of filter in for the ARK fund.
Let's talk about ARK, because of course Kathy Woods.
Do you want to pull up that chart as well?
Yeah. I can do that. Chart. Yeah. Okay. You lead off. I'll pull the chart up in a second.
Yeah. So I've just so there's this fund out there called ARK, which is the Kathy Wood fund, and it got a lot of it's got very diverse opinions upon them, whether it's all a scam or whether or whether, yes, she truly is a visionary for the future and things like that. So Michael put off a chart that just
checking. Are we going to talk about the innovation ETF? Is that the right one?
Yeah. Yep.
She's got innovation a few. ETF. All right. There you go. So that's the story of the ARK Innovation ETF.
Yeah. So coming out of COVID, I think into that we had this massive boom while they were the kings and everyone loved them, and then it all went away and everyone spoke about how they were idiots and all that type of stuff. So every year they put out some reports on innovation, and they're quite. I agree with a lot of the stuff they talk about. There's some I vehemently disagree with, but I think their problem, for my part, is largely that they've been price insensitive. So their argument has been, whatever it is, they've been the ones buying the equivalent of Cisco at $80, and Cisco's been great. They talk about, oh, here's Cisco, it's great, it's his building block of the internet, and it's its earnings going to double and triple and quadruple, and they were right, but they paid so much for it that it lost money, and it's so anyway, but I do think it's worth coming back, because they usually have a bunch of quite interesting charts that sort of just talking about what they're seeing. And a number of the things which they factor in are the ones I like. So I've got their five sort of big themes they're talking about. Now, artificial intelligence is at the center of it, and what so that's certainly a big growth center for the next little while. The question is where can you make money from that? And at the moment, yes, you can make money in Nvidia. You can make some money in the cloud computing, but in the end, for me, that's the real result will be this sort of productivity in sectors where you weren't expecting to see productivity. Productivity in sectors much more broader across the economy. And so there's been a number of things about programming speed, and if anyone out there is a programmer and hasn't been using ChatGPT to help along, you should start. Or Bard actually has got much better in its most recent iteration. And so, and then a lot of consultants as well. I saw so there was some of the two industries they picked on was, and not to denigrate consultants too much, but because there are definitely some consultants who do very good jobs, but there's also consultants who might be employed by governments like ours, where they're told what the answer is, and can you please work back to work out what the questions we need to ask so that we get this answer. So we have a predisposition to saying we want to build whatever this is, whatever this road is or railway is. Can you work out the assumptions and the wording to get there? And ChatGPT is pretty good at that stuff because it doesn't need to be right. It just needs to sound convincing. And so, so you don't need to tell, your 23-year-old graduate, go and write me 10 pages on why I should fire a bunch of people and give management big pay rises. I can just ask ChatGPT to do the same thing for me and then fix it. And so, so I do think there's a productivity wave in a whole bunch of industries, not every industry, but in a whole bunch of industries. And the other part is that it's democratizing a lot of this, a lot of the artificial intelligence. So artificial intelligence has been around for a long time. A lot of the things that are being done in artificial intelligence by ChatGPT were absolutely available, a year, 2 years, 3 years ago, in terms of being able to do a lot of these things. But you needed to know a lot about it, and you needed to be able to program in whatever languages, and you needed a lot more, a lot more knowledge and education to get there. And so only a very small amount of people could do it. Whereas now these large language models are democratizing a lot of this and letting, not anyone, but a lot of people, access to be able to do these. So that's one part. So I'm certainly fully on board with that. Multi-omic sequencing. So the cost to gather a sequence and understand biological data has fallen dramatically. So sort of giving us all this access to DNA and RNAs. And so the question is, are we going to see a lot more tailored drugs? Are we going to see a lot more, because of part of the AI sort of intersection is that if you're giving researchers who are quite knowledgeable but weren't AI experts, if you're giving them access to tools now where they can run much more analysis than what they used to do and interpret data at a higher level, does that mean that they're going to make some more breakthroughs? And there seems to be some reasonable odds that you get some answers there. Robotics, particularly through the onshoring and again, access to AI and more tools to be able to, more people to being able to program these things, makes a lot of sense. They highlight some of the 3D printing and reusable robots as being some of the big ones, and reusable robots I haven't done a lot with. I do think there's something coming. I don't know if it's imminent in terms of the economic breakthroughs there, but it's certainly one sort of worth watching. And 3D printing again is a cost factor, which it's every year the cost of 3D printing comes down, and so it used to be. Actually, sorry, let me put it another way. We're a long way away from you wanting to. You can 3D print, say, cheap toys, but they're way more expensive than buying it in China and shipping it over and that type of stuff. At the moment, it's still expensive parts that are worth 3D printing, and that's going to as that cost continues to come down over time, it's going to gradually you'll get to the stage where right now it's really expensive parts, then it'll become expensive parts, and then it will be moderately expensive parts, and eventually you'll end up with more broadly. But that's a trend which has certainly been slower than some of the other ones. So yeah. Energy storage is a huge one. So and that's the one particularly when it comes to electric vehicles, it's worth noting very much that an electric vehicle today, for me, makes economic sense if you're doing 50,000 kilometers a year or more. If you're doing close to 100,000, absolutely, you should be investing in. You should be, well, depending upon your charging cycles and all that, making fits. But if you're, say, running, a couple hundred kilometers a day, in a similar route every time, and where you can charge and all that type of stuff. You charge at the end of the day, and so you're doing 200 kilometers a day, and you get to recharge. Then yeah, absolutely, they make way more sense than petrol vehicles. But for the average person doing 10, 12,000 kilometers a year, they don't. But those battery costs are coming down every year, and they look like probably halving again over the next 5 years, and so that then suddenly opens up a lot more opportunities. And we're seeing China doing a lot in terms of subsidies in that area. Yeah, so that's those ones. And then public blockchains. I've got less excitement about public blockchains. So, but if you're a Bitcoin fanatic and you want to jump on and have a look at what they're saying, I support the blockchain technology. I think it's great. I think there are definitely uses. Sometimes though, blockchain can be seen as a if I already have a central database and a trustworthy and in multiple locations, whatever it is, and somebody that I trust to manage that, then maybe creating a blockchain and all the extra overhead that goes with it might not actually be worth it relative to storing it centrally. But it is quite highly possible a lot of the stuff they're talking about in terms of blockchain will be successful, but it won't be Bitcoin that actually or Ethereum that actually benefits from it. It'll be the same technology, but just used in a different way. Yeah. So some of the things I disliked, though, some of the graphs I liked. So ChatGPT getting to 100 million users. They've got this how long various platforms took. So Facebook took sort of 4 years to get to 100 million. YouTube took a little bit under 4 years. Instagram did it in 2 years. TikTok did it in about a year and a half. WeChat did it in under a year, and ChatGPT did it in a couple of months. So on a growth scale, it looks it's very impressive in terms of the amount of growth they've got. We spoke about cars a little bit before in Tesla. There's an interesting chart they've got. So if you look at the cost of owning a personal car, in $2020, it basically hasn't changed, didn't change for almost 100 years. So in 1871, they estimate that a horse and cart was going to cost you about $1.70 per mile. By 1934, you're driving cars for 70 cents a mile. By 2016, you're still paying 70 cents per mile. And they're looking by 2030, some of these autonomous driving ones to be at 25 cents. So, even if they're wrong by a factor of 2, like they're out by double, the cost is double what they think it is, it's still a pretty reasonable decrease in terms of the cost of running a car. Now, what would it mean if they're right and that autonomous cars do expand is that there's about 100 million cars done every year, and they're doing about 10,000 kilometers each. If you instead have autonomous cars, which are doing 70 to 100,000 kilometers a year, then basically you can retire 6 out of 7 cars. You just don't need to produce them because these autonomous cars will do, people will need to drive a certain distance. Maybe they'll drive further, but yeah, it still means you can get rid of a whole bunch of the cars. So that's a key one. I'm certainly keeping a very close eye on. Yeah, they noted that. I'm trying to think what other ones. There's a few other interesting charts. We might jump to I've just noting the time though, Martin. Maybe I'll bring a few more back for next time on that one, and we can
Sure. Well, let's
Jump
do
back
that
because otherwise we'll run out of room.
Yeah, we're running out of runway. So, but I guess before we close, let's just touch on China briefly, right? So, obviously, we had the China Evergrande, legal case in Hong Kong, which the question, of course, is to what extent will it be relevant for the main operating units in China, right? But the markets are a bit frozen out. They announced overnight that they're going to actually one of the government entities is going to buy more bonds. They've thrown relatively small amounts at the problem more broadly of the Chinese economy at the moment, and there does seem to be some willingness to, allow property markets to sort of go sideways or down. But we also note that a number of the completions of those many millions of outstanding has now been transferred from some of these building and construction companies to government entities to try and actually get them completed. So it's a real mess. And remember that only a relatively small amount of the bonds are actually internationally. So a lot of it's actually in China itself. But the broader question is this the antecedent to a more significant set of pressures on the Chinese economy? And does that have a blowback then to the Australian economy?
Yeah. And so I guess the first question comes, which I don't know the answer to, is, was this Hong Kong court, how independent was it in terms of its, it's basically just applying the rule of the law, really. The question is whether the Chinese government wanted them to apply the rule of the law, and I suspect they didn't. But actually, I'll take one step back and talk a little bit about Evergrande and Country Garden and some of these are the ones that are having problems. In some of the prior shows, for anyone sort of listening in who didn't listen to some of them, was sorry, that graph's not relevant, but yeah,
push some of
the prior ones. I pulled up the top 20 in terms of the developers and looked at their debt ratios, how much they have on their books still to produce, where they've taken the money but haven't built it yet, how much they've already built but haven't sold, which is different insofar as you might have sold 50 apartments in an apartment building you're building. But I've still got another 50 I've got to sell once it's complete. And so the 50 are prepaid, so I've got to build it for them. But then I'm stuck with these apartments I can't sell on the other side. So anyway, so if you look through all those different measures and how they're not paying suppliers and they're not paying employees and all that type of stuff like that, and you line up Evergrande and Country Garden versus the other top 20 developers, you can't tell who they are. Like just looking at the lines on the chart, there's not these massive lines out that go, oh, look how much debt these guys have compared to everyone else. They've all got lots of debt. They've all got lots of projects they need to complete where they've taken the money already but haven't finished it. They've all got these unsold properties sitting on their book where they've completed stuff but haven't actually managed to sell the properties yet. They've all not paid suppliers. They've all not paid employees. Like they're sort of running it some of them are running it sort of 6 months late in terms of paying their bills. It's endemic in the sector. And so what my thesis is on it is that entire sector is effectively government owned. Now, the government probably doesn't want to really own it, but they just want to keep this thing alive so that it doesn't bring the rest of the economy crashing down. And I'll use there's an interesting example in Japan called TEPCO, which is the company which owned the Fukushima nuclear power plant, where they had meltdown and lost the rods and all that type of stuff like that. And basically what would happen is every year, I think I haven't actually looked recently, but I think it's probably still happening, is that every year the government basically transfers a bit more money across to this thing and keeps them alive. And so whereas the and you sort of go, well, why would they do that? Why have we got this company that keeps losing money and then the government just transfers enough to keep them alive? And it's, well, the government doesn't want to own this. It's much better to have some private entity owning it. It's literally a nuclear waste dump, but at least we can blame somebody else and we just keep them alive, and so we can keep blaming them for it. And I think I look upon the Chinese property market in a similar way. Yeah. We're going to have this nuclear meltdown, or we're having this nuclear meltdown. And the government wants to be able to blame someone for it. You don't want to take blame. If you took over all these things and did all the projects yourself, now you're taking blame for it. Whereas if you leave these companies there, you can sort of tut those naughty companies who borrowed all that money when we kept on encouraging them, and then and then didn't magically get it all back when we told them to stop, look at them, it's all their fault. But in the meantime, they're giving them just enough money to keep them alive, keep these things building until they've built enough of the property that they can then, pull the pin and pull out. So so I'm treating that whole sector as being state owned. I suspect, and I think this is a great example of exactly what I said. Court comes out and says this thing's going to go bust, and then we start getting these announcements about, maybe we're just going to tip in enough money so that to keep this thing ticking over and building stuff, so that the whole Jenga tower doesn't come tumbling down.
Yeah, absolutely. And it's just worth interesting, think about the consequences. So this is actually the rebar futures from China, right? Which is, the end result of all the steel, right? And you can see there that we had a peak of 6,000. We're now at sort of 3,838. Now that movement's significant, right? Because of course the question is, what does it mean for the future demand for our own exports in Australia? Particularly, of course, because so much of what we are shipping is shipping to China. And, the steel price has been wobbling around a bit. It went down and it's come up a bit, and that's down slightly more. But if, in fact, the property sector continues to slow, and as you say, they continue to complete some of the stuff that actually is there, and I think there's another 2 years or so of completions to come. But new starts are way down.
Tanked,
which means future demand is probably going to crash.
Yeah, so it must have been. I've always had problems with the numbers you get out of these starts, because theoretically, when you look at it, you should be able to say, okay, how much have they got building under construction at the moment, and then how much do they complete? How many of those complete, and then how many new starts do you get? And those numbers should add up. So I have a billion whatever's under construction. I add 100 million. I finish 150 million. Well, I should go from 1 billion to 950. You should be able to make those numbers sort of add up. And they don't. They're out by miles. And I went through 6 months ago, I thought, look, I'm going to go through and find, am I stupid? Or am I just, and I went through and spoke to a whole bunch of China experts on it, and they all had the same comment, which was, no, the numbers, you're right, the numbers don't add up. They don't make sense. There's probably a lot of double announcements in terms of, okay, we started this thing and then we stopped, but we didn't count. We counted 100 million when we started it, or whatever. We counted 100. We counted 1,000 apartments when we started it, and then we quietly shelved it, and so they never took the 1,000 off, and then we started it up again, and so we added the 1,000 again onto the so you've got double the effect and things like that. So the question now is, so which of them's right? Is it the new starts that's right? Is it the ongoing stuff that's right? Or is it the completions that's right? Now, I'm guessing the completions are probably the most right, is my guess. If you took the completions and you spoke about there being 2 more years, if you spoke about the amount they've got under construction, and said, how long can they keep going? They can go for another 10 years with just what they say they're constructing. The thing is, they're probably not. There's probably lots of holes in the ground where somebody's turned the first shovel or dug a hole and then just decided, actually, I can't sell this stuff, and they're never going to complete it. And so, the real question for me, which I have no idea about the answer, is it 2 years? Is it 5 years? Is it 6 months? Like, when do they finally say, okay, you know what, we've built enough, we're just going, we can't build 100% of them. We're not going to build 0% of them. At what stage do they go, that's enough, now we can start pulling the pins on these developers? And that's the question I really don't know. But the interesting thing I was going to get back to on the whole iron ore thing is, iron ore prices are still really high. And if you went back, so you go back 2 years, and I turn to you, Martin, and I say, okay, this housing crash in the property sector is going to continue. We're going to see, developers falling over or almost falling over left, right, and center. We're going to see, those crater. In the meantime, we're going to have this green revolution where we're going to be producing solar panels and EVs. We're going to have an EV price war and too many EVs in China and all this other stuff going on. Now, which is going to be better, copper or iron ore? And you would have turned and gone, well, copper. Copper's being used in all these EVs, and it's got all these green metals and building all this transmission. And you go, well, the opposite's happened. And so what we've seen is all these, lithiums and copper and all these energy metals that sort of supposedly involved in the in the broader green sector, they're the ones that have suffered. Meanwhile, iron ore's held up really strongly. And I don't. That seems like sort of the Wile E. Coyote moment. It's iron ore's it's over the edge of the cliff, and it's just running on thin air, and at some stage it's going to drop. But when that happens, it's hard to tell. I would have thought it would happen 6 months ago, but it's defying gravity. So, I mean, if you bring up the Fortescue share price, I think we're hitting pretty close to record highs on that.
Yeah, we'll have a look at that in just a second. I mean, as with all of these things, the expectation and reality is often a bit different. This is the Fortescue, right?
Yeah.
You can look at that, basically.
Is their biggest customer having a huge housing crash? Exactly. It doesn't look like it from the chart.
Yeah. And Rio, of course, is not quite the same sort of trajectory as Fortescue, because of course they've got a different business model. But it does show you that in some areas we are still seeing quite a lot of momentum. And as you say, the sort of the theory of what's going to happen, what actually is happening is the problem. It's diverged significantly.
Yeah. And when you look at the what you spoke about was important, though, insofar as Australia's like the world's biggest supplier of lithium, for example, and a pretty big supplier of copper and all these other metals but when you look at how much export revenue we get from lithium and in taxes and stuff like that, it's tiny. And same with copper. And you get through all these other metals and you're like, well, yeah, we make something from it. We're a major supplier in the world, but they're just not that big. Whereas when you look at the big ones, iron ore and coal are the real huge ones. That's where all the revenue comes from. That's why, we can afford tax cuts and stuff like that, is that all this extra revenue is coming through from those. And, last time we had an iron ore boom, well, not last time, but 10 years ago, 15 years ago, when we had an iron ore boom, and then we took all those temporary profits and gave them away as tax cuts to the middle class. And looks like we're
doing the same again.
We'll be done again.
Exactly.
Yes.
Just on lithium, just so people can get the contrast, right? This is the China lithium metal spot. It's dropped considerably from where it was previously, and that's an interesting observation.
Yeah, and so lithium. I don't know if I've spoken about that before on here. The thing to think about with lithium is that it's going through some incredible growth. It is genuinely in a super cycle. You keep hearing these resources super cycles, and mostly they're bull. Like most of the resources super cycles we've been speaking about are they're just normal cycles. Cycles happen in resources. The boom we saw in the 2000s, early 2000s, that was a super cycle. We saw production volumes, up 20, 30, 40, 50%, like all these new mines coming on. That's a boom. We're building all these new mines and prices are booming. That's a super cycle. That's what's happening in lithium. And the question with that is there is this incredible amount of lithium coming on in terms of new projects. And there's incredible growth as well. And so the thing is, if demand for lithium grows by 40% next year, but supply grows by 42%, the price goes down. If supply grows by 35%, now the price is going up. And who knows whether it's going to be, like when we're talking about these massive year-on-year growths, it's very hard to tell where it's going to be. Now, as a general rule, the way I look at it is the companies within that sector need to be able to, if they can produce profitably, then they're going to do more of it. If you look at lithium, a bunch of it's hard rock, a bunch of it comes from salt flats, and you basically dissolve it and pull the salt out. The hard rock is sort of like $5,000 a ton or below is typically your costs. The ones where you're coming from the salt flats and things like that, you get up closer to $7,000 or $8,000, maybe even as much as $10,000 a ton. So when you see prices of $70,000 or $80,000 a ton that we saw, everyone's producing as fast as they can. Now, if prices fall below 10,000, you're going to see some of these mines either shut down or start thinking about shutting down or stopping their expansions. So where would I look at the prices? below $20,000, you probably want $15,000 to $20,000 to encourage new demand coming on because they need so much extra. 15 to 20 below. Okay, now I'm thinking about buying it. It gets to 70 or 80. I'm absolutely thinking about selling it. In the 20 to 30 range is probably where we're going to see it for the next few years, I would guess, because we need so much of it, and you need a price signal to spark the demand. But you're going to go through it because the growth is so extreme. You might go through a year where prices languish at $10,000, and then and then not enough comes on, and the next thing you know, we're back up to $60,000 or $70,000. It's going to be volatile because of the extreme growth that you're seeing within that.
Yeah, and just to give you a bit of a flavour there, this is Liontown Resources, right? So that that's what happens, right?
Yes, come off the other side of it.
Yeah, exactly.
Yeah, and look, and this is exactly keep coming back to this point. When you look at the growth in volumes, so I mean, in the end, for these, I'm not sure about Liontown in particular, but I'm pretty sure they're increasing their volumes. Most of these guys are. When you look at the amount of extra lithium that's coming on, it's going up every year. It's going, every month with more lithium, more lithium, more lithium. Like that's what these guys are there to do. Get in there, pull this stuff out of the ground and produce it. And so fundamentally you go, I thought the lithium market was going to expand and these companies were going to grow production. They did. It's a question about how much you want to pay for that. And that's, can't stress that enough. Keep coming back to that point. You get your fundamentals right. But then this next question is, how much do I pay for those fundamentals? And I think we've shown tonight, we've spoken about, the ARC fund, about what they're doing and how they often get it wrong. We've spoken about, the iron ore sector. We've spoken about cars, Tesla, and lithium is just one more example of that. Yeah. Great. There's a great story behind lithium. They're going to grow. They're absolutely going to grow. We need way more batteries. We need lots more into it, but it doesn't mean you pay any price for it.
Yeah. And so there's two observations, because I think with ARC, so they got some of their thinking right, but timing wrong. And that's the first risk. You can actually go in too early or sometimes go too late. It's also true, of course, that you've got these contentions between, different sectors of the market and different markets. And so if you look at the performance of the US versus Australia, well, the US has done a lot better than Australia for all sorts of reasons that we've touched on some of those. So it makes the complexity of trying to think about asset allocation and stock picking. I mean, this is not simple, And
also there's sometimes like that. We spoke about the costs in terms of driverless cars and coming down.
Yeah.
So we go through this whole thing where we're like talking about, and I'm on board with them saying, yeah, look, driverless cars could be much cheaper. And so we could we could get rid of whatever it is, 70% of the world's auto production could just go because we just don't need it anymore. And in the meantime, ARC's out there buying Tesla. And so you're like, well, yeah, but isn't there a conflict there? Anyway, so
yeah,
there's it's coming back to the point, I guess, is that people are even if you sort of poo-poo some of their results and laugh at, look at these guys buying these stocks at crazy multiples, it doesn't mean every bit of thinking they ever do is going to be wrong. And I actually think some of their longer term look at some of their thoughts on sectors and trends is actually pretty good for a lot of it. And it's well worth at least looking, and even if it's different to yours, at least challenging your own market views with those. I don't always think they get the conclusion right, but I think their inputs are often good.
And that's part of the point, isn't it? You can get multiple voices, multiple views, and then pick and choose.
Yes.
But nobody has perfect foresight. Nobody gets it right 100% of the time. And I guess it's ultimately, as we've said a few times, question one, what happens if you get it wrong? What's the downside risk? And question two, if you need to be in the market, then, you've got to make these decisions. You can't necessarily just withdraw and say, I'm not playing.
Yeah. And I speak to lots of people about this whole idea about, 0 or 1. There's a lot of people who are like, okay, you're telling me the market's expensive, you've got these concerns or whatever. Okay, I'm going to be 100% cash. And it's like, yes, but, I can paint different timeframes. And the question is, if the market goes into a bubble, it can go, let's say we're looking at the market and saying, we think it should be cheaper. We think it should be 20% cheaper. But then over the next 5 years, we're actually expecting it to grow by 10% per annum. And so, it goes down 20 and then up 50. Or maybe it just sits at 20% higher and just goes sideways for a few years and then takes off from there. it jumps from that 20 to the, and then it sits sideways. It's a question about timing and time frame, and nobody's right. As you said, nobody's got an exact crystal ball. And so the question is saying, it's diversified. I don't like taking absolutes of like, I'm all in the market, I'm all out of the market, I'm all in the market. Not only do you raise tax problems, but you got lots of timing issues. And so, having at least some exposure is important.
Absolutely. Well, Damien, we've done it again. We've got into our time,
Yes.
but we covered most of the things we wanted to touch on. So I appreciate your insights.
So.
And
we've left lots more for next time, though.
Well, I was going to say, we can always make sure that the same as in now. We should explain that, of course, the RBA is now flicking to 6 weeks. But if you're up for it, I'm still, great if you come back early next month, because I think monthly is about the right cyclical periodicity for these, even if it doesn't now fit with the RBA.
Yes, yeah, absolutely. That's what we're doing.
And I've put links and things below if you want to find out more about the World Funds and Nucleus Wealth. We think that the transparency and openness that Damien and his team have is pretty amazing. And there are lots of different formulations. And just as we sort of end the show, Damien, let's underscore again, there are different ways of engaging with what you do, right?
Yeah, absolutely. So we do active, we do passive. With all the portfolios we run, it's all about transparencies and letting people sort of put overlays on the portfolio. So you can see every stock that we own. You can see the reasons why we own them, and then you can go over that and say, okay, I want some extra cloud computing stocks, or I don't want any carbon stocks within my portfolio, or whatever it is, that either fits your investment view or your own personal ethics. And the idea is that if we've got this portfolio, it's like a core portfolio that sits in the middle, and you can see every asset that's in it, and you know why they're in there. You can then put other stuff around that. So, if you can look at that portfolio and go, okay, they don't own any cryptocurrency. If you want to do something on that, you can do something. If you look at it and you go, I want cloud computing, you can go, oh, actually, they've already got a reasonable exposure to cloud computing. Maybe you want some more, but I don't need to buy as much as what I might have, because I know that my superannuation fund or my own personal fund has got these investments in it. I can actually see what they are. And yeah, some people like to, for example, if they work in the banking sector, they might cut out all the banks, and they might say, well, okay, I already get stock from my company, or I already work in that sector, and so my salary is exposed to that. I'm happy to take that much exposure there, and then within my investments, I don't need that extra exposure. So yeah, lots of different types of things like that we do for everyone.
Yeah, terrific. Well, thank you very much, as always. Really appreciate it, and look forward to catching up again next month. And I'll take you offline and just close us out. See you later.
Thanks. See you.
Thanks. So there you go, folks. Hope you enjoyed that. Very interesting conversation, as always. And next week, it's just me. I'll be on, and I'll be talking about the financial stress and modeling that I've just done till the end of the last month. A lot of very important insights coming out of that, and we'll look at the postcodes and things. So that's the show next week. And in following weeks, I've got a few other guests coming on. So keep in touch with the live streams. And of course, meantime, I continue to make my recorded shows and post them most days. And some of those are doing very well. Please like and share, as always. Really appreciate it. Thank you very much for all the super chats, Jason in particular, and others too. Really appreciate that. And I'll look forward to seeing you very again soon. Just to say, the dogs are still here. I'm not sure that I can interview the dogs, but they are certainly part of the stream and part of the show. Anyway, I want to say thank you very much for spending some time with us this evening. Have a good evening, and I'll look forward to seeing you next time. This is Martin North from Digital Finance Analytics, signing off. Cheerio.